They want you to believe it was a bubble that popped. They want you to think that Chinese retail investors got ahead of themselves, that social media hype drove irrational speculation, that the fundamentals could never justify $84 silver. They want you to sell. They want you to panic. They want you to believe that the 14% crash in a single session proves that silver was overextended and the rally is over. They are lying to you, and I am going to prove it. Let me take you through exactly what happened during Christmas week, what happened when London traders returned on Monday, and why the narrative you are being fed by the mainstream financial media is a carefully constructed gaslighting campaign designed to shake you out of your position at the worst possible time. During Christmas week, something remarkable happened, with Western institutional traders on holiday. With the major banks closed, with liquidity thin and volume light, silver began to move. It wasn't a slow grind, it wasn't a measured appreciation, it was explosive, and the fire was being lit in China. Chinese financial media was reporting on silver around the clock. Claims of an impending global shortage were circulating. Structural supply deficits were being linked to the explosive growth in photovoltaic solar installations. The narrative was simple and compelling. The world needs silver, the world is running out of silver, and the price must go higher to reflect this reality. Chinese retail investors, already primed by years of watching Western financial manipulation and increasingly distrustful of dollar-denominated assets, piled in. The UBS Guo to silver investing LOF, China's only pure-play silver ETF, saw such extreme buying that trading was halted on Friday. The market price of the ETF had soared more than 60% above its net asset value. 60% premium. Chinese investors were so desperate to get exposure to silver that they were willing to pay 60% more than the underlying metal was worth just to own shares. When trading resumed, the premium remained at 34%. Think about what that means. Chinese investors were paying $1.34 for every dollar of silver in the fund. That is not speculation. That is not irrational exuberance. That is panic buying. That is the behavior of people who believe they are running out of time to get positioned before the price runs away entirely. And the premium wasn't just in the ETF. Shanghai silver bullion set a new local auction record, rising above 19,400 yuan per kilogram. When you convert that $2, Shanghai silver was trading at over $86 per ounce, the London price at the same time around 78. Chinese buyers were paying an 8 premium over the international benchmark just to get physical metal. $8. That is not a rounding error. That is not a transaction cost. That is a premium that screams physical shortage in the Chinese market. It tells you that the metal is not available at the paper price. It tells you that if you want actual silver bars delivered to you in China, you have to pay significantly more than what the COMEX or LBMA claims the metal is worth. Copper followed a similar pattern, increasingly substituted for silver in some solar applications. Copper spiked to fresh all-time highs on the Shanghai exchange before quickly retreating. The entire commodities complex in China was being driven by a single narrative: supply deficits, industrial demand, strategic accumulation. And the US dollar was collapsing. Over Christmas, the dollar fell to its lowest yuan exchange rate since mid-2023. A weaker dollar makes commodities priced in dollars cheaper for foreign buyers, which accelerates demand. Chinese buyers, seeing their currency strengthen against the dollar, were converting yuan into hard assets as fast as they could. This was the perfect storm: thin holiday liquidity, Western institutional absence, explosive Chinese demand, weakening dollar, and a fundamental narrative around supply deficits and solar demand that was, and still is, legitimate. Silver hit $84, gold hit $4,550, and then Monday came, when London traders returned from the Christmas break. Everything changed. In a single session, silver plunged more than 14%, gold fell 4.6%. The entire Christmas rally was erased. Copper crashed. The precious metals complex went from explosive rally to violent liquidation in hours. The mainstream media immediately had their story ready. Chinese speculation drove holiday surge, they said. Violent, reversal erases holiday gains, speculative blow-off. Overextended positioning, social media amplification. Let me translate that for you. What they are saying is, Chinese retail investors are dumb. They got caught up in hype, they bought at the top, and now reality has reasserted itself. But look at the timing. Look at who was trading during the rally and who was trading during the crash. During the rally, it was Chinese retail, Asian markets, thin liquidity, minimal institutional participation. During the crash, it was London traders, Western institutional desks, full liquidity, maximum participation. Do you see what happened? The rally occurred when the Western establishment was not at their desks. The crash occurred the moment they returned. This was not a natural market correction. This was a deliberate takedown. The article I am reading from explicitly states, when London traders returned from the holiday break on Monday, price discovery abruptly normalized with dramatic consequences. Normalized, that is the word they used, as if the Chinese-driven rally was abnormal, as if the only valid price is the one determined by London and New York, as if Asian demand and physical premiums are irrelevant. This is the arrogance of the Western financial system on full display. They are telling you that when Chinese investors drive the price up, it is speculation. But when London traders drive the price down, it is normalization. They are telling you that physical premiums in Shanghai do not matter. Only the paper price in London matters. But here is the problem with that narrative. The physical market is screaming shortage. Shanghai silver traded $8 over London. Chinese ETFs traded at 60% premiums. These are not signs of speculative excess. These are signs of supply shortage in the world's largest commodities consumer. The article tries to downplay this by saying limited physical tightness evident. They cite bullion borrowing costs in London and lease rates as evidence that there is no acute shortage. Gold lease rates hovered near 1.3%, they say. Silver lending rates remained elevated but didn't signal acute shortage. Let me explain why that argument is garbage. Lease rates in London tell you about the availability of metal in London vaults. They do not tell you about the availability of metal in Chinese vaults, Indian vaults, Middle Eastern vaults. They do not tell you about the premiums that industrial users are paying to secure supply. They do not tell you about the delivery queues or the lag times between ordering metal and receiving it. The London lease rate is a paper market metric. It reflects the cost of borrowing metal that probably doesn't physically exist or exists, but is encumbered by multiple claims. It is a derivative of a derivative. It is the shadow of the metal, not the metal itself. Meanwhile, in the real world, in the physical world, Chinese buyers are paying $8 premiums. That is the real market. That is price discovery. And the London traders came back and said, no, that price is wrong. The real price is 14% lower because we say so. And they crashed it. How? By selling futures contracts, by dumping paper, by overwhelming the thin post-holiday market with institutional selling that had nothing to do with supply and demand and everything to do with reasserting control. The article lists the forces that converged to cause the crash: overextended positioning, speculative excess, stronger dollar, and risk asset hesitation. Let me address each one. Overextended positioning, according to whom? According to the technical indicators that the same institutions use to justify their selling? The price had raced far ahead of underlying fundamentals, they claim, but the underlying fundamentals include a 6-year supply deficit that Metals Focus themselves project will continue into 2026. The underlying fundamentals include China restricting 65% of refined silver exports. The underlying fundamentals include solar installations at record levels. By what measure were we overextended? Speculative excess. The rally was amplified by retail participation and ETF flows rather than physical market tightening, except we just established that Shanghai was paying $8 premiums, which is definitional physical market tightening. The fact that retail was buying does not make the move invalid. Retail was buying because the fundamentals justified buying. The institutions were absent because they were on holiday, not because the opportunity was not real. Stronger dollar. Yes, the dollar rebounded from holiday lows. But it rebounded because the Fed is perceived to be holding rates higher for longer, which is itself bearish for economic growth and bullish for safe haven assets like gold and silver over the medium term. A temporary dollar bounce does not invalidate the long-term dollar debasement thesis. Risk asset hesitation. Global equity markets struggled to sustain record highs. And when equities hesitate, where does capital go? Historically, it goes into safe havens. Gold and silver should benefit from risk asset hesitation, not suffer. None of these explanations hold water. What actually happened is that London came back, saw that the price had run during their absence, saw Chinese retail accumulation, and decided to punish it. They sold the market down, triggered stops, shook out weak hands, and reaccumulated at lower prices. This is the playbook. This is what they always do. Let the price run when they are not watching. Crush it when they return. Blame retail. Blame speculation. Blame anything except the coordinated institutional manipulation that just occurred. Now let me address the long-term fundamentals because this is where the article really exposes its agenda. They quote Metals Focus saying that 2025 marked a turning point where total silver consumption declined despite record solar installations. Rising prices, they claim, are incentivizing aggressive thrift and substitution by manufacturers. First, even Metals Focus admits that the silver market will be in deficit for the 6th consecutive year in 2026, 6 years of deficits. Where do they think the metal to cover those deficits is coming from? The vaults are draining. We have documented the 70% drawdown in Western inventories. Metals Focus can project a smaller deficit, but a deficit is still a deficit. Supply is still less than demand. The market is still not balanced. Second, the substitution argument is hilarious. Yes, manufacturers are trying to reduce silver content in solar panels. They have been trying for years, but silver is the best conductor of electricity. You cannot fully substitute it without sacrificing efficiency. And as solar panel efficiency becomes more critical in a competitive market, the ability to reduce silver content diminishes. Copper is being substituted in some applications, the article says, and yet copper also spiked to all-time highs in Shanghai before crashing. If substitution was solving the problem, why did copper also run? The answer is that the demand for conductive metals, whether silver or copper, is overwhelming the available supply. Substituting silver with copper does not solve the problem. It just shifts the shortage from one metal to another. Third, the argument that current fundamentals do not justify parabolic price action ignores the fact that markets are forward-looking. The price today reflects expectations for supply and demand 12 months from now, not 12 months ago. If the market believes that the deficit will persist, that industrial demand will grow, that China will hoard, that the dollar will weaken, then the price should reflect those expectations. A parabolic move is not proof of speculation. It is proof of repricing. The article dismisses the Beijing export license decision as a catalyst for speculative frenzy rather than reflection of immediate supply disruption. But the licenses went into effect in January. We are in January. The supply disruption is not theoretical. It is happening right now. Chinese refiners are restricting exports. The metal that used to flow west is staying in China. This is immediate supply disruption, not speculative frenzy. And yet the article concludes that the sharp reversal was less a repudiation of long-term themes and more a textbook speculative blow-off. In other words, they admit the long-term themes are intact. De-dollarization trends, structural silver deficits, industrial demand all still relevant over multi-year horizons. But in the short term, they claim the price was pushed beyond sustainable levels. Sustainable according to whom? Sustainable according to the London traders who make money by keeping the price suppressed so they can accumulate? Sustainable according to the paper market that has been manipulating precious metals for decades? The physical market in China said $86 was sustainable. Chinese industrial users paying $8 premium said the price was justified. But London said no, and London has the institutional firepower to enforce their opinion through futures market manipulation. This is the war we are in. This is the battle between physical reality and paper control. And Monday's crash was not a repudiation of the bull market. It was the establishment reasserting control after losing it for a week. Here is what you need to understand. The 14% crash does not change the fundamentals. It does not refill the vaults. It does not increase mining supply. It does not reduce industrial demand. It does not make China's export restrictions go away. It does not solve the deficit. All it does is reset the price to a level where the institutions are comfortable accumulating again. They let it run to $84, they sold it down to $71, and now they are buying it back. This is the shakeout. This is the transfer of metal from weak hands to strong hands. If you sold during the crash, you gave your metal to them. If you held, you survived the shakeout. And if you bought the dip, you positioned yourself for the next leg higher, because the next leg is coming. UBS is still calling for $85 in Q1 and triple digits by year end. Jim Rickards is still calling for $200. The supply deficit is still real. The solar demand is still growing. China is still restricting exports. The dollar is still being debased. Nothing has changed except the price. And the price is now cheaper. That is a gift, not a disaster. The article ends with trading considerations that include strict risk management and research of fundamental drivers versus speculative positioning. And I agree, research the fundamentals. The fundamentals say by Monday's crash was orchestrated. It was predictable, and it was temporary. The Chinese buyers were right. The Shanghai premium was real. The supply shortage is real. And the price will reflect that reality once the institutional games are exhausted. Hold your metal by the dip, and understand that when London crashes the price 14% in a day, they are not proving you wrong. They are proving they are desperate. See you in the next video. Keep stacking.